Thank you very much, Bill. Thank you. So I'm going to start by asking the Baronesses, why did you get involved with the campaign on cost disclosures?
Right, thank you. I'll start this off. Well, it was around the middle of last year that I discovered the issue for myself when I was involved with test marketing of a prospective new fund. And I remembered from my time in the European Parliament that there had been an issue about investment companies wrongly being put in PRIIPs. And so when I was told by some pension managers that they because of the cost issues, they were no longer investing, I investigated, spoke to the London Stock Exchange people and said, well, oh dear, why don't we try and fix this with an amendment to the Financial Services and Markets Bill, which was then going through the Parliament. So I put forward an amendment. That was at report stage, so it was unlikely to get anywhere, although I did have a few speakers in support, but it enabled me to speak on the effects that were going on. And at that point, the minister said, well, it was all, the macro situation, but I got agreement that we could submit evidence to the contrary. And so over the summer, by contacting with industry, we were able to get a great deal of proof to the Treasury. And so from that point, we've moved forward, getting to the situation where we are today, where the problem is much more understood, especially by ministers, and there are possible hopes of getting a solution.
I got involved actually when Baroness Bowles alerted me to the situation during the passage of the bill that she was referring to, and I immediately realised its significance in relation to institutional as well as retail investors, including in particular pension fund investment in real assets, which is so important to the UK and which pension funds want to invest more in, and which the government wants them to do that as well. So it was a shame that Baroness Bowles' amendment wasn't accepted, but at the time I didn't realise how serious the issue was. And of course, it has become more and more serious over time. So I've been supporting her excellent work and the work of the fantastic industry group as well to highlight this topic. And I really have become more and more alarmed at the lack of urgency in remedying the problem, which has been admitted by regulators and government, even as its impact has become increasingly serious. And we could make changes more quickly, but somehow nothing has materially happened on the ground at all.
Thank you. Do you think you could spell out for us why you think this is important for investors, please?
Sure. I mean, there are many reasons that damaging UK listed investment companies is so important. Firstly, they offer the only route for retail investors and indeed many pension schemes to invest in a diversified, expertly managed portfolio of UK-based real assets, which include infrastructure, real estate, renewable energy, and other important sustainable growth companies, which can help them meet their desire to invest in green projects and also their ESG objectives. So these are precisely the kinds of companies, 60% of investment companies now are in real assets, but even the diversified equity portfolios offer a great opportunity, especially when at a discount. And secondly, this type of investment is really important to the economy. So it's important to all of us, as well as to the UK financial markets. And by depriving these companies of new funding, up to £7 billion a year, it is estimated, have been lost to the country. The government and the industry recognise the need to ensure more pension funds invest in the UK economy. But at the moment, the opposite is happening. And pension funds have told me They're buying overseas investment funds for exposure to these small growth businesses that we really want to back, and also to sustainable and alternative energy or infrastructure, because non-UK listeds don't show misleadingly high cost figures. And pension and retail investors have been pulling out of the UK sector, and they won't buy them at the moment because it's too difficult to explain these false, misleading cost disclosures. And this has affected wealth management portfolios as well. Despite the widening discounts, and this is what really gets me, and fiduciary duty concerns, the poor price performance of the UK investment companies can actually be used to justify steering clear of them anyway, which is a classic doom loop that seems to me to place short-term appearance over long-term value to the detriment of all of us.
If I could just add, I mean, if you think about the role of investment companies, they're a third of the FTSE 350, and there's a handful in the FTSE 100. So the demise of fundraising through that issue, including the almost total absence of IPOs, has a negative effect on the overall perception of the UK stock market and the economy. And of course, that has a broad effect on the returns of all investors. And even if you can see it very directly in the alt sector, where things are just not happening at all. But even in the equities sector, where it's holding up a little bit better, nevertheless, there is not the injection of permanent capital to sustain the capital markets that one would expect to have. And though it might be moving from share to share, it is still a basic chunk of money that is missing from supporting the whole index. Another aspect of it is that in essence, investors are being manipulated. And they're being manipulated into believing that investment companies, investment trusts, are essentially the same sort of thing as open-ended funds, when they're not. And just because there's a fund manager somewhere in there, and some people want to compare whether you're getting the same kinds of value for money without recognizing you can do different things in investment companies. You can have leverage. And the fact that with open-ended funds, it's money that has yet to be paid, whereas the share price is forward-looking and has already taken all of these things into account. So by giving the misleading information, that is then manipulating investors unwittingly into making possibly less good investments, not getting the returns they should. So everybody should be worried.
So to return to the subject, so is legislation then the answer to this?
Well, I think that this is where it starts to get sort of more interesting in terms of moving towards a solution. In the context of the present legislation, where we've taken legal advice, an easy solution lies in obtaining the correct interpretation of the wording in the MiFID organisation regulation, which was put up by Bill at the start. So getting that correct interpretation of value and the fact that there are no deductions from the share value. Now that could be done if the FCA chose to do it by changing their interpretation, or it could be clarified by instruction or an amendment, essentially coming from the government. And that appears to be the track that we're going to have to go down, with the government preparing a statutory instrument that makes that clarification, also in the context of moving forward to the new legislation that is going to replace it. So we need a fix that covers both the current situation and whatever comes after it, to make sure that the same mistake is not replicated. So I think there are some people that are still wanting to do various comparisons and to say, well, even if we don't wrongly represent the costs, we're curious to know what they are. And of course, they already exist in the company accounts and annual reports. They're there quite clearly. And for any ordinary share, that's where you're expected to go and find them. But, you know, we could make life simpler for people by lifting them out and having them on a separate sheet, and have already been some suggestions made for that. There's no reason why that just can't be an agreed industry standard. I mean, that used to be how the UK did a lot of things by industry standard. Indeed, whilst I was in Brussels, I can't tell you how many times I was told, well, why can't you say that, you know, the best way to do this and that is most flexible is to do it by industry standards. But of course, that couldn't be accepted in the single market context because they just didn't trust it, didn't coordinate it. Well, are we going to go back to that, or aren't we? And I would say that additions and extras that are not really needed can be put into industry standards. But we would think it very peculiar if we asked ordinary trading companies to start separating out and listing the costs and expenses that they had. But maybe that is something that we can say, well, we are sort of hybrid with an investment company, so we'll do that to acknowledge it. And then those that want to make, where there are some comparisons, for instance, equities with equities, but even so, as I've mentioned before, they're not exactly the same when you can have leverage in one and not with the other.
Of course, legislation would offer a solution, especially as the FCA keeps saying that they're just abiding by the law. But firstly, the timetable for laying and passing regulations or primary legislation means it takes an inordinately long time. And this has been going on for far too long already and is having such a damaging effect. But secondly, as Baroness Bowles says, there could be non-legislative routes which we believe can and should be used and could fix the problem quickly. Reinterpreting the annex for the MiFID regulations so that our own companies are treated the same as those of all other countries, even those subject to the same laws, would overcome the current position whereby it's only the UK that's reporting these exaggerated and incorrect figures to investors, suggesting the investors are going to pay fees for holding the shares, which is simply not the case. It is the case for open-ended funds, but not for these listed companies. And of course, it's important to ensure transparency for investors, with all the company expenses and any investor charges being disclosed. They are shown in company accounts and investor information. Cost relative to NAV should also be disclosed. But what shouldn't happen, but it is misleadingly happening right now, is to tell investors that they will face deductions annually from their share value, when in reality they won't, because the so-called OCF does not apply to a closed-ended company in the way that it appears to do, and in the way that it does to open-ended. So this is actually directly contrary to the consumer duty, which is apparently one of the reasons why we're having these supposedly clear, fair, and not misleading charge disclosures anyway, because the consumer duty says all the information for investors has to be clearly, fairly, and not misleadingly disclosed, so they can make properly informed decisions. These investment choices are not being informed properly. The FCA could fix this if it recognized the same interpretation as every other country is doing. But sadly, so far, for some reason, it's choosing not to do so.
James, should we take this question that's just on the screen at the moment as it relates to something that Baroness Bowles has just said?
Yeah, fair enough.
Baroness Bowles, I don't know if you can see that question, but perhaps for for everyone's benefit, if we just read it out. It just arrived whilst you were speaking a short time ago.
So costs in investment trusts have already been taken is what you said, but in open-ended funds yet to be paid, surely both vehicles accrue their management charges on a daily basis throughout the year, so the daily NAV for an investment trust and the daily price for a NOIC include the prescribed proportion paid so far. So I think this is talking about costs in NAVs rather than costs in price.
Yes, I couldn't hear that all that clearly, but I think the question is sort of pointing to the fact that there are some operations like calculating the net asset value that go on daily, if you like, and similarly both in open-ended and closed-ended funds. And that is reasonable, and an investor would want to know what the assets are. I mean, in a sense, similar sorts of things, but maybe not quite so frequently, go on with ordinary trading companies. You know what the assets are, and they're published in the accounts. That doesn't make them into a different type of entity. Every company holds assets of some kind and has to have a valuation. Because of that similarity, then some people say, well, yes, we want to compare the two. Well, there are comparisons that are available, like the costs relating to NAV as a percentage that have often been published. And there's nothing wrong with those kinds of things as tools. But you can't tell investors that you are going to have a deduction from the value that you hold of your investment, because with the investment companies, it has gone round the loop of the market already taking all of that into account and setting the share price. And so there isn't a deduction yet to come. As I said earlier, the market is forward-looking. The share price is forward-looking, bakes it in. That procedure, that market issue isn't there in the open-ended funds. So they have to run on valuations, and the costs are done retrospectively, and there isn't something that is taking account of it. So the deduction from NAV comes directly off the deduction of the holding, because what you're entitled to there is a share of that holding. There's no such entitlement in an investment trust. You can't go along and say, hey, I want my share of the NAV.
Yep.
You sell your shares, and it's a different process. And to try to and for that not to be appreciated by those purchasing them is a very bad thing, because it means they then don't understand discounts and they don't understand the different risks.
Yeah. What really worries me here is this obsession with focusing on this figure OCF when you're comparing an investment company that's listed with an open-ended fund. You know, the discount in many cases will offset many years of a tiny fraction of a percentage difference in OCF. Yes, you need to know what the managers are charging, but to suggest to an investor that the discount is not at least as important as these other elements of value, and what alternative opportunities there are for you to find these investment opportunities, etc. You know, I feel that somebody has lost the plot when we are focusing so heavily on driving down supposed management fees rather than looking overall at measures of value, including discounts, including type of investment being held. These are misleading to the investors that are supposedly going to be given the information they need to make a properly informed decision.
Thank you. Just thinking about PRIIPs for a minute. So there was quite a big response to the government's consultation on the replacement for PRIIPs, which is the sort of old legislation. So what was that about?
Well, that's about future legislation, because even if we get the MiFID fix on the interpretation of value that we've been talking about, the current legislation isn't going to last forever. And actually, right at the root of the present disclosure issue is another matter in the interpretation of what is a PRIIP. And the same definition was proposed to go into the new consumer composite investment. And this definition requires the investors to have an entitlement to an amount repayable. And as I've already explained, you don't have that entitlement actually if you are owning a share in an investment company. So on that basis, the suggestion was that we shouldn't have investment companies as a consumer composite investment. And in fact, that's the position that most of Europe takes. And if you take that position, you don't get tipped into the relevant bit of MiFID either. So the interpretation point there also goes away. The problem is the FCA doesn't look at investment companies for the purposes of this definition as a going concern. It treats them as if they were in bankruptcy, and therefore you would have entitlement to a share if anything there is left of the NAV. And so again, the point of the response is to say, no, you have to take the reasonable going concern situation, because that's the reality that is happening almost all of the time, except in extreme circumstances. And for competitive purposes, that should be done. So exemption from PRIIPs, which is where the FCA departed from the rest of Europe in its interpretation, we suggested should be corrected in the replacement.
Some people said that they'd still like legislation to cover investment company disclosures. Do you think that's sensible?
Well, obviously, you will need to disclose all the relevant information for investors, of which management fees is just one part. But disclosing these figures could be done via a proper and accurately measured industry standard. Baroness Bowles mentioned this before. It would allow disclosures for all closed-ended listed companies to be compared across markets, across countries, just as the EMT is an industry standard now, but unfortunately, as far as UK investment trusts and REITs are concerned, it is fundamentally flawed and drives investors away on a false premise. But this kind of standard disclosure shouldn't compare different investments as if they are the same. And that's at the heart of this problem for me. You know, the industry has already been working actually on standard disclosure templates. The group of industry experts has been devising its own template that could be used, because investors need accurate disclosures so they can see clearly the information they require presented to them without being misleading or pointing them in the wrong direction. And it did used to be one of the strong points of the previous UK financial system, that not everything was fixed in rules that take months or years, it seems, of consultation if you want to change them. And that was where flexibility was incorporated into a principled-based framework. But we seem to have forgotten that.
You know, I mean, I think it would be wrong if the replacement PRIIPs legislation, the consumer composite investment legislation, were to continue to cover investment companies on the basis of the definition that is there. I mean, if they chose to make it having within it a definition that properly encompassed for some reason or other, because they're not really products, as we've already explored, but if for some reason that was the decision that it had to be so, you still have to make the rules that fit the job and fit the type of instrument that it is. And so then you could still come back to the position of saying, and there will be specific disclosures that work like this, but they won't be such that it causes this sort of misleading information. You could write such things into legislation, but it would be far more flexible if it was left as an industry standard, because the way the system is clogged up at the moment, not just with changing all the retained EU law, but the fact that we have to consult everything to death before it happens. I mean, it will probably take about a year for anything to happen, even once the statutory instrument sort of leashing the FCA to do anything happens. That just is not the agility that we were promised with Brexit.
Has the FCA actually agreed to hold meetings to discuss this with campaigners? Are there any reasons why the FCA is given for not recognising the same interpretation as other countries?
Well, we've had meetings with them, but they haven't really come up with any convincing explanation at all. I mean, it's almost as if they didn't know some of the information that they needed to know to realise this was happening, because at the beginning they said to us, well, other countries do it too, which if they exist, we've asked them, they haven't been able to evidence that, and we haven't found any evidence at all. So, you know, I think it is deeply concerning that the regulator is not properly informed, it seems, about how the market itself is working, even though it's in charge of regulating it.
I mean, I got information from ESMA that confirmed that there were no investment trusts listed on Morningstar from Europe that had any cost disclosure figures. But we had to provide the figures, like the ones Bill showed, to the FCA. They didn't seem to be capable of going and getting them for themselves. And then the reason I know they take this gone concern view was because that was specifically how it was elaborated to me and Ros and John Barron in a meeting that we were having with the FCA, actually with some Treasury officials present there first. What the FCA won't do is meet everybody in a big round table. I tried to organise that initially, and the idea was that we would have not have hundreds of people, but have, you know, 2 or 3 from industry, plus us parliamentarians, plus the FCA and Treasury. And that was arranged, but then they pulled out from it and said, no, they would only meet industry and parliamentarians separately. So, I mean, I'm seriously concerned about the lack of transparency in having to have these sort of fragmented meetings, so that nobody really knows the whole picture and who said what, except perhaps the FCA. And I don't really think it's sustainable for good regulation.
Thank you. Can I ask about Baroness Altmann's bill that's going through the House of Lords? How will that relate to cost disclosures?
Well, yeah, the idea for this bill was initially to ensure that there would be a legislative vehicle going through Parliament which could accelerate the necessary changes. Baroness Bowles and myself both put in 4 private members' bills, and for some reason I seemed to get picked in the ballot, so at least there was one that could proceed, and it was intended to remedy these misleading cost disclosures and simplify the double layers that seem to arise when you include investment companies in AIFMD. But when it came to the drafting, it ended up being rather more complex, involving several different pieces of legislation. So we put in a kind of belt and braces approach, but it's become clearer that as far as cost disclosures are concerned, not all the clauses in the bill are strictly needed, but the package itself offers a way forward to help the government. And ministers have said they want this remedied quickly, so that the government could still bring back the bill now. And once it's been through the Lords, it's got its next stage on the 1st of May and then 3rd reading on the 10th. it will go to the Commons, and the essential part is really the removal from MiFID. And the government could choose to postpone the other elements of the bill or introduce amendments when it passes to the Commons so that it can pass, hopefully, quickly. I don't want this to stray over, because as soon as an election is called, we lose all this kind of legislation. And the government still has a chance in the Commons to take account of the various developments and views that we've been hearing over recent months.
Yes, I think it would make sense to recognise in the bill, by some kind of tweaking at a Commons stage, the timetable and sequencing of where the government's got to, in that it started to do look at AIFMD, and a consultation will be coming down the track. So you could just postpone the AIFMD bit to join up with that consultation, possibly specifically saying there should be a consultation on coming out, because we can't guarantee otherwise that there would necessarily be that consultation question. So you can still use some of the AIFMD content to make sure it's properly consulted on that aspect that would get rid of double reporting and things. But the bit that would just be enacted immediately would be the MiFID fix. And if the government gave time to the bill, they could do it. And that would avoid, at least temporarily, having to have a year of consultation by the FCA.
Fair enough. You mentioned the possibility of an election coming up. Do we know what the attitude would be of if we had a Labour government? Do you know what they would think about this issue?
Well, we had cross-party support going through the Lords. Labour, I think, seems to recognise why this is so important without question. And Labour has already said they want to encourage more investment in by pension funds, for example, in Britain, and alternative energy and sustainable growth and all that. So I'd be surprised if they weren't on board. But unfortunately, it does seem worryingly, I think, to parliamentarians that the FCA has powers regardless of what the government wants it to do, and that you need to wait for the parliamentary timetable before you can get the FCA to do anything, even when government wants it to be done. The economy clearly needs it to be done, and the FCA has already recognised that it needs to be done. It's just taking its sweet time.
I mean, we did have support from the Labour front bench when discussing Rosa's bill and the need for government intervention, which all sort of came into the debate, and they all supported the government intervening. Now, of course, FSMA doesn't give the government much opportunity to intervene. It's very retrospective. You can have an inquiry 3 years after something was gone wrong, and no doubt that might be where we end up if something doesn't happen soon. So there is the will, but I think what is also happening is that more and more people, certainly in the Lords, where we sort of mooch over this kind of thing longer, we're all recognising that there are drawbacks to the system that we have enacted originally in original FSMA, and which we have just replicated. That there are no emergency powers, basically. There are some in banking through the Financial Stability Board and others, but when it comes to the markets, there aren't any emergency powers to do anything quick when there's a disaster.
Yeah, which is a great shame.
Yeah.
The AIC has been putting forward its case to members. I think they've written to some boards. I just wanted to ask you, I don't know if you see that or not, but I think it's got some fallback provisions that it's proposing. Do you think that makes sense, or do you think there needs to be a fallback provision?
Sharon?
one of the things that you do, and I've done a lot of negotiation, having negotiated all of the legislation that is currently about on our financial statute book, is you don't go into a negotiation with your second best offer on show. Maybe that's why I was successful, because I've done commercial negotiations. To some extent, we've already covered this ground in the discussions that we've already had, because we've done a little bit of what-ifing, in the sense that if we don't come out of the new legislation completely, then you have to tinker with both the definition and then hopefully leave it to an industry standard. So that there are things that you can do that are of the nature of fallback positions. The letter itself seemed to stem from an earlier document that the AIC had circulated, and it was very unclear what they were intending in that earlier document, because they seemed to be saying treat open and closed-ended funds the same and get them all outside cost disclosures. Well, that just that's not right for open-ended funds, because they're not doing reports and accounts and the same sort of thing that a listed company is. So, but that wasn't repeated in the letter. It was sort of vaguer, and I just think that has caused a lot of confusion. But we've moved the agenda on quite a lot with the sort of high-profile nature of the campaign we've had, with the fact that that actually some 575 companies and people have joined in the consultation responses and subsequent letters to the Chancellor and to the Times. Now that is a totally unprecedented number of industry participants sticking their head above the parapet, and that's initially, knocked the Treasury for 6. But it does seem to me that the Financial Conduct Authority will still trying to undermine that, despite their duty to consult. That's a bigger number than has ever answered any consultation of theirs, and still they want to ignore it because they say, well, there's one or two, and they won't say who, where, why, or what, think that it should be done the way they're doing it.
I must admit, I cannot quite fathom the AIC's so-called fallback position, which doesn't seem to deal with the problem, and it sort of contravenes the position they say they want. If it does agree with everyone else who has responded in this way, that currently you are misleading investors and telling them they are paying so-called ongoing investor charges, which are not ongoing investor charges, but are part of the management expense structure of the company that they've invested in, then you can't say your fallback position is to say to them, well, actually they are. This makes no sense to me. And I think we really do need to get back to basics here. What is the purpose of charge disclosures? It's meant to give investors clear information they need on which to base their investment decisions. Now, if you are telling them information that is incorrect, and you're not at the same time highlighting really important information that they need to know to consider alongside other factors, then actually you're not acting in the consumer interest at all. And I don't see how the FCA believes that any of this situation complies with its statutory objectives, which include the consumer duty, of course, but more importantly, to protect the integrity of UK markets, to ensure international competitiveness, which is part of its remit. This is undermining a large part of the UK financial markets. We've seen that, unfortunately. I'm not saying it's the only element. Of course, there are other factors, but this is the homegrown bit. This is the big own goal that we could resolve, and we could start bringing people into the debate about how to decide whether a closed-ended investment company that holds assets for you and you're a long-term investor is better suited to you than a different type of structure. And if so, are UK listed companies more attractive than non-UK? Are the discounts making it a very attractive proposition or not? Are the dividends making it attractive or not? What's the gearing level? There are so many factors that seem to have been boiled down to one that isn't even being properly explained. I just don't get how the AIC isn't jumping up and down all over this. I have sympathy with them because I know they've tried and were trying in 2018, but things have moved on since then. And we really do need to sing, I think, with one voice here and not confuse everybody.
And the question is the investment companies industry is mostly owned by UK investors. Would changing the MiFID disclosure rules attract significant additional flows from overseas?
I would hope so. You know, this is a really excellent sector with some really excellent companies and funds in it. And it could be attractive both domestically and internationally. But why, if you were not even a UK investor, would you want to necessarily buy the UK at the moment, which has been hampered by a number of different factors? You know, okay, we've had the pandemic everywhere. We haven't had Brexit everywhere. That's in the past. But then you look at the MiFID tables and you think, well, why would I buy a UK fund that charges me 2% to hold it when the European or other US funds that I could buy don't charge anything? It just, what's wrong with international investors here?
I mean, I think at the moment we are getting some investors coming in order to try and take advantage of the discounts. And if you can buy the whole investment trust, you can get some nice juicy assets for a lot less than they're worth. And so, but that's not really the scenario that we're talking about.
And it's not in the interest of long-term investors here either.
But in generally, our markets are open. If investors want to come in, yes. But the whole point, as Ros has, outlined right at the beginning, is we're desperate for there to be more investment into UK equities, into UK real economy. That with the freedoms that there are in pensions and the defined contributions and taking control of those, this is just the moment for expansion into these kinds of assets. And people want them. They want to try and do a bit of good. And there's just no other instrument that is available to allow the retail investor, and if you like, we'll call it the sort of retail pension investor, to be able to do this.
Yeah. I think I've got one question that I'd like to. If we want to take this forward, if we want to push back against something and try and get something changed, should we as an industry be tackling the Treasury or the FCA or the AIC, or who is it that we should be pushing to make the changes?
All of the above.
Yeah, all of the above, and saying the same thing. And I think the other thing to remember is when consultations come around, don't be too keen to say yes or even yes but. If it's yes but, you put no first and then put what needs to be changed before you can say yes. And when you get to the end of the consultation and you see the anything else box, don't leave it empty. Put in things that are needed, because I think we're far too soft in our responses to consultations, and we're led by the nose to say yes.
And I think the DWP has also got a role here, by the way, which we have not yet tapped. But if the FCA were to move, the DWP would, I'm sure, fall in line. But the more people that are banging on about this and don't let go, the the more likely we are to hopefully make some kind of breakthrough. The media has a lot also that they could offer, you know, just keep highlighting the ridiculousness and the danger of what's happening.
Thank you. Thank you very much for your time. I think it's 12 o'clock.
Yeah.
Building to wrap up.